Hello and welcome to MC Explains, an investor education initiative brought to you by Money Control and Invesco Mutual Fund. The markets are in correction mode, and if you are getting fearful, you need to know that when markets fall, it's really the time to start buying good quality stocks. But if selecting stocks is too much work, you don't understand the nuances, and you don't have time left after your day job, then it's best to turn your attention to quality mutual fund schemes. But when there are 1,000 or more equity mutual fund schemes in the market to choose from, how do you pick the quality ones? Today we are going to talk about the top 4 features that you can use to filter out equity schemes from the plethora that is available. The first thing you need to consider is the type of equity scheme you want to invest in. There are many out there. If you are just starting out with equity investing, it's best to stick to diversified equity fund categories, and there are 7 basic categories of these: large cap, large and mid cap, multi-cap, flexi-cap, ELSs and small cap. Venture into mid and small cap if you have a very long investment horizon and a slightly higher risk threshold. For basic inflation-beating long-term returns, large cap, large and mid-cap and flexi-cap can work well. ELSs is a category which, along with a diversified portfolio and long-term inflation-beating returns, also offers tax saving under the old tax regime. Based on your personal goals and risk tolerance, you can pick at least 2 diversified equity fund categories. Having all 7 will not help, as that gets into the territory of over-diversification, which then is not incrementally productive for returns. Unless you are an experienced and long-time market investor, it's best to stay away from sector and theme-based funds. Some other concentrated portfolios like focused are also best left to the experts. The reason being that returns in such portfolios can be cyclical and volatile, which may not be aligned with your purpose of long-term wealth creation through reasonable inflation-beating returns. This brings us to the second feature, which is performance. Performance is a measure of returns, or what the fund is able to deliver over a specified period of time. Besides considering returns over a distinct period, you will be better off considering rolling returns. Rolling returns measure defined period returns every day. For example, you can look at 3-year rolling returns for the last 5 years. This means you are going to see the average performance of a fund based on 3-year return every day for a period of 5 years. This is a lot more comprehensive picture as opposed to just a point-to-point return, be it for 1 year, 3 year, 5 year or any other defined time period. Rolling returns seen for long periods like 5 and 10 years will help you ascertain the consistency with which a fund is able to retain performance. When compared with similar rolling returns of the benchmark, you will get an idea of how consistently a fund is able to beat its benchmark or not. Looking at returns is only one side of the coin, so you must consider risk as well. Risk in equity investing is partly volatility and partly quality. If you consistently invest in low quality funds, you will find that the returns are unable to beat the benchmark returns. Volatility, on the other hand, is part and parcel of equity investing. What you want is a fund that is able to rein in the volatility better than others. Sharpe ratio, information ratio are 2 risk-related statistics which mutual fund schemes are required to publish, and these will help you get a sense of how risky your fund is. Generally, the higher the ratio, the better the risk-adjusted returns. While both help you assess risk-adjusted returns, the information ratio is a measure against the scheme benchmark. The question it answers is, how consistently is a scheme able to beat its benchmark. With the Sharpe ratio, you can understand how consistently an equity fund is able to generate excess return against a standard risk-free rate of return like that of the government bond yield. Both are useful in understanding the quality of returns generated. Consistently producing better risk-adjusted returns indicates that a fund can maintain its active advantage through market cycles and is a strong indicator of effective and high-quality portfolio management. Lastly, and very importantly, do some work around the scheme's pedigree and also the asset manager and their documented investment process. The scheme pedigree will show up in the risk and return analysis we spoke about earlier, but also check in on the portfolio hits and misses. Were there any stocks selected that carried above normal risk and hurt the portfolio? Is the fund manager part of the portfolio for a reasonable time, or is it a new fund manager? Is it an altogether new scheme? The asset manager's investment process is also important to look at. Are they known to stick to it, or are there frequent diversions? The latter, of course, is a red flag. What is the equity capability of the fund house? These 4 pointers around category, risk, return, and asset manager will help you narrow down that list from 1,000 to a few tens. Once that is done, you can further filter down the list on the basis of a combination of near-term return and portfolio dynamics. This does sound like a bit of work. Get the help of an advisor and you can ask them the questions around these 4 features. It's in your interest to take the time out initially to do this work. That's it for now. Thank you for watching and stay tuned for the next informative episode around mutual fund investing on MC Explains.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.